The whispers have turned into pronouncements. For years, Bitcoin was an outsider, a curious experiment discussed in niche online forums and dismissed by the titans of traditional finance. Yet, something fundamental has shifted. BlackRock, the world's largest asset manager with trillions of dollars under its control, filed for a spot Bitcoin ETF. Fidelity, a giant in the retirement and brokerage space, has deepened its commitment to digital assets. These are not speculative ventures. They are calculated strategic moves made by some of the most powerful financial institutions on the planet. This is the proof, the undeniable evidence that the institutional herd is not just coming. It has begun to arrive. Their arrival is a signal, a profound change in the perception and function of Bitcoin. This essay will explain precisely why this influx of institutional capital is not just another market trend, but a potential catalyst for a structural revaluation of Bitcoin. At the very heart of Bitcoin's economic model lies a simple yet profound principle: absolute scarcity. The protocol, the set of rules that governs the network, dictates that only 21 million Bitcoins can ever be created. This is not a corporate promise or a government policy that can be amended by a board of directors or a legislative body. This is a mathematical certainty enforced by a global, decentralized network of computers. No matter how high the demand climbs, no matter how much the price increases, no one can print more Bitcoin to satisfy the market. This makes Bitcoin's supply perfectly inelastic. It does not respond to price changes. This is a characteristic it shares with no other asset in the modern world. This concept of fixed supply is the bedrock upon which the entire investment thesis rests. In traditional markets, when demand for a commodity like oil or copper surges, prices rise. This price signal incentivizes producers to drill more wells or open new mines, increasing the supply and eventually stabilizing the price. When demand for a company's stock rises, the company can issue more shares. For over a decade, Bitcoin has battled a perception problem. To many mainstream investors and regulators, it was synonymous with illicit activity, technical complexity, and extreme volatility. It was seen as an asset for cypherpunks and speculators, not for serious long-term portfolios. This narrative, however, begins to crumble when the most respected names in finance publicly enter the space. When a firm like BlackRock, which advises governments and manages the retirement savings of millions, decides to offer a Bitcoin product, it acts as a powerful signal of legitimacy. It is a public declaration that they have conducted extensive due diligence and concluded that Bitcoin is a viable, investable asset. This endorsement has a profound psychological effect on the market. It provides career risk insurance for other, smaller financial advisors and fund managers. Previously, a wealth manager recommending Bitcoin to a client might have been seen as reckless. If the investment performed poorly, their judgment would be questioned. However, when they can point to the fact that BlackRock, Fidelity, and other giants are also involved, the conversation changes. The recommendation is no longer a radical act, but a prudent consideration of a new asset class validated by the industry's leaders. For institutions to invest trillions of dollars, they need more than just conviction. They need infrastructure. They require secure, regulated, and efficient on-ramps to access the asset class. For years, the lack of this financial plumbing was a primary obstacle. Buying Bitcoin meant dealing with unfamiliar crypto exchanges, managing private keys, and navigating a complex and fragmented market. This was a non-starter for a pension fund or a large corporation with strict fiduciary duties. The creation of new financial products, particularly spot Bitcoin ETFs and institutional-grade custody solutions, has solved this problem. A spot Bitcoin ETF is a revolutionary product for accessibility. It allows any investor with a standard brokerage account to buy shares that represent ownership of actual Bitcoin. This is a game changer. An investor no longer needs to create a new account on a crypto exchange, worry about self-custody, or understand the technical nuances of the blockchain. They can buy IBIT just as easily as they buy shares of Apple. To truly appreciate the scale of the change underway, let us move from the abstract to a concrete example. Consider the global pension fund market, which holds over $50 trillion in assets. These funds have a singular, solemn duty: to grow their capital steadily over many decades, to ensure they can meet their obligations to retirees. They are, by nature, conservative and slow-moving. They do not chase speculative fads. Decisions are made by committees of experts based on rigorous analysis of risk and long-term potential. For years, Bitcoin was off their radar, deemed too volatile and unproven. Now, imagine a shift in thinking among these committees, spurred by the legitimacy conferred by BlackRock and the availability of regulated ETFs. A few pioneering pension funds make a small, exploratory allocation to Bitcoin. They are not betting the farm, they are taking a calculated risk. Suppose a fund allocates just 1% of its portfolio to Bitcoin. For a $100 billion fund, that equals a $1 billion purchase. One of the most persistent criticisms leveled against Bitcoin is its extreme price volatility. How can something be a reliable store of value if its price can swing by 20% or more in a single week? This volatility has been a major deterrent for institutional adoption and everyday commerce. But the institutions that volatility once scared away are now poised to tame it. The market's character will change as ownership shifts from short-term retail speculators to long-term institutional holders. Historically, retail investors dominated Bitcoin. They are driven by emotions, social media trends, short-term narratives. They panic sell during downturns, pile in with leverage during euphoria, amplifying price swings both ways. Institutional investors operate on different principles and time horizons. A pension fund or insurance company allocating to Bitcoin isn't aiming for a 30% gain next month. They make strategic, multi-decade allocations. These institutions are the market's new anchor tenants. Their capital is sticky. The impact of institutional adoption extends beyond corporate balance sheets into the realm of sovereign nations. As Bitcoin becomes more liquid, more stable, more integrated into the global financial system, it becomes a viable candidate for central bank foreign reserves. A reserve asset is a high-quality asset like gold, like U.S. Treasury bonds, held to back liabilities and provide stability in crises. For a nation-state, holding Bitcoin could be a strategic move to diversify away from a U.S. dollar-centric system and to hedge against geopolitical and monetary risks. Holding a politically neutral, decentralized asset like Bitcoin lets a nation store value outside any single nation's control. It is a bearer asset that cannot be frozen or seized by a foreign power, unlike dollar-denominated assets. El Salvador's adoption of Bitcoin as legal tender was a pioneering, controversial first step. While the case for a supercycle driven by institutional adoption is compelling, the path forward is not without significant obstacles and risks. It would be naive to assume a straight, uninterrupted line to higher valuations. The most prominent headwind remains the regulatory landscape. Governments around the world are still grappling with how to classify and control this new technology. A coordinated, restrictive regulatory crackdown by major economic powers like the United States or the European Union could severely impede the flow of institutional capital. Unfavorable tax treatment, outright bans on certain uses, restrictive banking policies. Another significant risk is macroeconomic in nature. Bitcoin does not exist in a vacuum. Global liquidity conditions, interest rates, the overall health of the economy. In a severe risk-off environment where a major financial crisis causes investors to flee all assets perceived as risky in a desperate dash for cash, Bitcoin's price would likely suffer alongside stocks and other growth assets. Its status as a safe haven is still being tested. A prolonged global recession could delay or diminish the appetite of institutions to allocate new capital. The narrative surrounding Bitcoin has irrevocably changed. Its journey from an obscure white paper to the trading desks of the world's largest financial institutions marks a pivotal moment in financial history. The arrival of institutional capital is not merely another bull market cycle. It represents a fundamental rewiring of the asset's role in the global economy. This shift is built on a clear and powerful logic. An immense new wave of demand, driven by legitimacy, enabled by new financial products, colliding with a perfectly finite supply. This is the simple, powerful equation that defines the next supercycle. We have seen three critical ingredients from institutional influx. First, it brings legitimacy, transforming Bitcoin from a speculative curiosity into a recognized asset class. It provides air cover for a wider range of investors. Second, it delivers liquidity and infrastructure, spot ETFs, qualified custody, frictionless on-ramps for trillions. Institutional investment, legitimacy, plus liquidity, plus limited supply, long-term growth. Bitcoin started as a fringe idea, but with financial giants investing billions, it's transforming into a mainstream digital asset that could rival gold as a global store of value. Today's boardroom decisions at BlackRock, Fidelity, and their following pension funds will echo for decades. They are laying groundwork for a system where a decentralized digital asset sits alongside gold, government bonds, as core parts of a global portfolio. Don't just watch the price, watch the flow of funds, watch regulatory developments, watch the institutional products being built. You are watching the blueprint for the next financial era being drawn in real time. Thanks for watching. Please like and subscribe. It will help us grow and reach more people.